All right, so hello everyone. Good evening or good morning, depending on which time zone you're from. Great to see all of you again, and welcome back to day 3. This is day 3 of the Black Market event. If you can hear me and you can see my slides, do me a favor and just let me know, type yes into the chat box and let me know where you're from as well. That would be great. And we have got people from Singapore, from Sydney, from California, from Florida, from Belgium, from Israel, from Malaysia, Hong Kong. I see Portugal, I see Yishun, I see UAE, I see Dubai, I see Australia, Italy, Lithuania, Ghana, Philippines. Okay, too many to mention, but welcome everyone to this webinar. Let me just get my desktop sorted out and we are good to go. Great. So I do hope that you managed to catch the first 2 days of the Black Market event, where the first day I talked about stock investing, value investing, as well as Alson Chu talking about price action manipulation. Yesterday, Bang Pham Van and I talked a lot about options trading. So I do hope you caught that. If you miss any of the sessions, no worries, or you want to watch it again, we'll send you a limited time replay pretty soon where you can watch those webinars again and take lots of notes. Yeah. So for today's session, my focus is going to be on short-term swing trading. Short-term swing trading, how do you identify high probability trade opportunities, which you can trade with stocks and you can also trade with options. And of course, by using options, that gives you some additional advantages as well. But of course, you can just trade with stocks, plain vanilla. Yeah. So there's a lot to learn today. Again, take lots of notes. And if you have questions, you can post it on the Q&A tab. And I'll do my best to answer your questions at the end of the webinar. At the same time, do take advantage of our crazy big discounts of 60 to 75% off, which happens only once a year during the Black Friday sale, which is now. Yeah, I know people have been waiting 11 months for this period. So go grab it and equip yourself with all the skills so that you can really start to beat the market in the years to come. Yeah. Okay. So let's begin. Now, a lot of people who are new to the markets would say, Adam, on the first day, you talked a lot about stock investing. Yeah. How many of you attended the stock investing webinar on the first day? Right. So today will be on stock trading. And some people would say, what's the difference between investing and trading? It's totally different. Totally different. There are two totally different approaches of how to make money in the markets. It's like two totally different games. It's kind of like golf and basketball. They are two totally different games. I mean, they both involve balls and putting balls into holes, right? But very different rules. Like in one game, you can touch the ball. In the other game, you touch the ball, you get a penalty. Okay, so it's the same thing. Now, the best analogy that I can give is that investing is like getting married, whereas trading is like a one-night stand. Now, let me ask you this question. If you want to marry someone, what do you look for in that person? You want that person to have all the great qualities, all the great fundamentals. You want the person to be intelligent and funny and well-educated, loving, honest, good values, all those great things before you marry that person, right? So same thing with investing. So you learn on the first day that to invest in a low-risk, low-stress way that will give you very great returns, you want to invest in what? Only the top 1% of stocks in the world. These are companies with the solid fundamentals. Do you guys remember some of the things I talked about? We only want to invest in businesses that have got consistently increasing revenue, that are very profitable. They increase their profits every single year. They increase their free cash flow. They've got sustainable competitive advantage. They've got all these great qualities, and then you invest in those companies. Same thing, you want to marry people who have got all these great qualities, right? Because when you invest in a great company, then you don't have to look at it anymore. You don't have to put a stop loss. No worries. You know that it would keep going up over time, right? But trading is different, right? trading is like a one-night stand. So let me ask you this. Let's be a bit naughty here. I know that we don't do it for real, but let's just be a bit naughty, right? So if you're going for a one-night stand, must that person have all these qualities? Must they be highly educated, have good values, good education? Yes or no? No, right? If you're going for a one-night stand, as long as the person is attractive, hot, let's go for it, and that's it, right? So same thing for stocks. Same thing for stocks. Have you noticed that there are certain stocks that may be overvalued, but they keep going up in the short term? Or there are certain stocks where the company is full of crap. The company is losing money, but the price goes up, right? Because in the short term, there's the momentum, there's a hype, yeah? How many of you also want to make money on some of these stocks where the company may not be great, but the stock will go up in the short term, and you want to get in and get out before it collapses? How many of you? We call these speculative stocks, correct? So again, while we invest in only the top 1% of companies, we want to get married to the top 1%, the other 99% are for us to play with them. This is for the one-night stand. You understand? So for the one-night stand stocks, we have to use protection. Remember, one-night stand, you got to use protection. Okay, very risky. So when you do stock trading, you got to put a stop loss. So the moment you enter, if the stock goes down, you got to cut loss immediately. You can't stay there. But for investing, you're getting married, no protection, because these are great companies. They will always go up. You hold it through the ups and downs. Do you understand the analogy right now? Now, how many of you also agree that there are some people who may be great for one-night stands? They are great as a date, but you never want to marry them because they are hot, they are sexy, but they are not loyal, they are not reliable, correct? Yeah, so same thing in the stock market. Same thing in the stock market. There are some stocks that are good for trading, good for hit and run, but you never want to invest in them because they are not safe to hold for the long run. They may be way overpriced, or the company doesn't have consistent profits. So these stocks are only good for short-term trading. Yeah. So again, for today's session, our focus is going to be on the one-night stand stocks, the speculative stocks where we just hit and run as fast as we can with protection. Got me so far? Okay. By the way, I'm just curious, how many of you in the past, you have made the mistake of marrying a one-night stand stock and then you got killed? Anyone has done that before? Yeah, so remember the golden rule. Never let a one-night stand become a steady girlfriend or steady boyfriend. You got to leave the next day. You got to get out the next day, okay? So very different. You got to separate them. Yeah, you got to separate them. Okay. Now, some people would then ask me, Adam, can I do both? Can I do both investing in great companies and at the same time on the side, I do short-term trading? Okay, could you do that? Yeah, so that's what I do. So for me, I've got my investment portfolio where I buy great companies and I hold them through the ups and downs, the top 1%. I don't need to touch them at all. In fact, when they drop, I buy even more. But I've got my trading as well, where I just go in and out and in and out and in and out. And I've got my stop loss. I catch the fast movement. If it reverses down, I get out very fast. So I do both investing and trading. Now, of course, in real life, please don't have a wife and go, or husband and then cheat at the side. Huh? Don't do that. Don't do that. Only do that in the financial markets. Play out your fantasy in the financial markets. All right. So why can we do both? Because it's different objectives, right? So the main objective in investing is to compound your wealth, to compound and compound into huge amounts of money. But in the process of compounding in investing, you don't touch the money. You want to invest money that you don't touch in the next few years. Let it grow and compound. Got it? But for trading is different. For trading, we aim to make short-term profits where we get in, get out, and we generate short-term cash. So many of my students, what they do is they trade, and the short-term cash that they generate, they use that cash to then put into their long-term investments to compound as well. Or at the same time, they use the short-term cash from trading to pay some of their expenses. So you can do that as well. Yeah. So today will be on trading. So are you excited to start learning? Trading. Okay, great. So as you guys know, there are many trading strategies that I teach that you will learn in the stock trading course. And for today, I'm going to focus mainly on one of those many strategies. And the strategy I'm going to focus on today is called the slingshot mean reversion strategy. So this slingshot strategy is quite versatile. It can be used not only in stocks on a clear trend, but it can also be used for stocks that are in a consolidation pattern. That means it's like not a clear trend. You can also use this technique. And the great thing about the slingshot is it helps us to identify when stocks tend to be near a short-term bottom, ready to reverse up, or near a short-term top, ready to reverse down. So let me begin by sharing that this first strategy called the slingshot mean reversion. But before I teach you the strategy, let me teach you some basic principles of how we build up the strategy, right? Okay, so with that, let me go to my charts. Let me open up my charts first. Okay, there we go. Let me just open up one of my charts over here. Right. Now, whether a stock is on a clear trend. What do I mean by a clear trend? Let me do a bit of drawing for you guys so you get what I mean. Okay, so whether a stock is on a clear trend like that, right? This is an uptrend. Now, why is this an uptrend, by the way? Because an uptrend is defined as a pattern of higher high points. So this is a high, makes a higher high, makes a higher high, right? And this is a low, makes a higher low, makes a higher low. So when you see higher highs and higher lows, that is what we call an uptrend. This is an uptrend pattern, okay? Now, sometimes a stock may not be on a clear uptrend. It may be in a very broad consolidation pattern where it kind of like goes sideways like that. Have you seen that before? Okay, so this is kind of like a consolidation pattern. This is kind of like an uptrend pattern. Yeah. So whether it's on an uptrend or in a consolidation, notice what happens to the price. The price moves in waves. It moves in wave patterns, right? You've got wave up, wave down, wave up, wave down, wave up, wave down. Same thing over here. Wave up, wave down, wave up, wave down, wave up. It's always wave up and it's always wave down. So as traders, we want to be able to identify, okay, how do we know it's the bottom of the wave down? So we get in before the wave up, right? Or how do we know it's the top of the wave up? So we get in before the wave down. That is the most important question, okay? Now, can we always predict 100% exactly where's the bottom of the wave down? Exactly where's the bottom of the wave up? Of course not. No one can predict 100%, but we can identify high probability turning points. We can identify high probability turning points. That means it's not guaranteed 100%, but it's a high chance of a turning point. So how do we do that, right? So the first thing is we can use what is known as oscillators. Let me write this down. It's called oscillators. Oscillators. Now, what are oscillators? Oscillators are a kind of indicator that helps us to know when the price is overbought or oversold, all right? Now, think of the price like a rubber band. What happens when you pull the rubber band too much down? When you pull a rubber band like that too fast, it snaps back, right? When you pull the rubber band too high, what happens? Snaps down. So same thing with how price moves. When the price of a stock goes down too much, we say it's oversold. Write this down. It's called oversold. The rubber band is like too low and it has a tendency to snap up. So oversold means what? Oversold means ready to go up. When the price has gone up too much, we say it's overbought. Like the rubber band, ready to snap down. Understand? So how do we know it's overbought and oversold? That's what oscillators do. They measure overbought and oversold signals. Now, there are many oscillators, many of them, okay? There's no such thing as the best oscillators, but there are two of them which I like to show you today, which are very well known. The first oscillator is called Bollinger Bands. Bollinger Bands is a type of oscillator, right? Another type of oscillator is called stochastics. By the way, there are also many other oscillators, like you have got the Williams percentage R, you have got RSI. So there are many of them, all right? And you can use anyone. You can use anyone, but I like to use at least two of them at the same time. So let's look at Bollinger Bands and then stochastics. Let's begin with Bollinger Bands. So whatever charting software you use, you can put in the Bollinger Bands. So let me just put it in over here. There. Okay. So some of you may not be familiar with it, so I'll just describe it very simply. So can you see that now the price is kind of like enveloped between this upper line and this lower line? We call this upper band, and this the lower band. Can you see that? So these are what we call Bollinger Bands. Now, how do we use Bollinger Bands? Again, when the price, so this is the price of the stock, right? When you see the price pierces or penetrates the upper Bollinger Band, like can you see here, it goes above the upper Bollinger Bands? Can you see that? When the price goes above the upper Bollinger Bands, it tells you that it is overbought. It means the price is overbought and there's a probability it will come down. Understand? Now, here's the problem. When it's overbought, the indicator cannot tell you how much it's going to go down. It can't tell you that. Will it go down a bit or a lot? That it can't tell you. It can only tell you that it is likely to go down. That's it. All right? So can you see over here, it went above the upper Bollinger Bands and then it went down. Same thing here. Now it went below the lower Bollinger Bands, means it's over what? When it goes below the lower Bollinger Bands, it's over bought, oversold. It's oversold. So oversold means high chance it's gonna snap back, like rubber band, right? So snap back. Can you see that? Now, how about this? Is this considered overbought? Is this considered overbought? No, okay, because it did not go out of the Bollinger Bands, right? Now, how about here? Is this oversold here? Oversold? Yep, went up. Okay. Here, slightly oversold, went slightly out of the band, went up, right? Then over here, you can see it went above. Now, did it go down? Yes, it went out only a bit, right? It went out only a bit and then went up again, and then it went down again. So, like I said, it can't tell you how much it's going to go down. It just tells you that it's likely to go down. Sometimes it may go down a bit and then goes up again, all right? Then here, again, oversold, goes up, overbought, goes down, right? Here, overbought, goes down. Here, oversold, goes up. You get the picture? All right. Now, yeah, this is on a daily candle chart. You can also use it on a weekly candle chart. You can use it on an hourly chart, but most of the time we use it on daily and weekly candles, right? Now, is it as simple as this? Or just put a Bollinger Band and hit the lower band, buy, hit the upper band, sell? Is it so simple? Of course, it's not so simple, correct? So when we want to enter a trade, we cannot just use one indicator. We have to use several to increase the probability, right? One is not enough, okay? So this is just one. It's kind of like you're a lawyer and you want to win your case. You can't just give one piece of evidence. You must give a lot of evidence so that your case is beyond a reasonable doubt, and then you can win the case. Understand? Yeah. So this is just one, the first indicator that will give you a probability of a reversal. Now, the second oscillator we're going to use is the stochastics. Let me put in the stochastics now. There we are. Again, whatever charting software you use, it will have stochastics. And the settings that I use is stochastics 533. Everyone has their favorite settings. My settings are 533. Now, I'm not going to go into the mathematics of why 533. I just tell you it's 533, okay? And I'm just going to show you how I use it, okay? So for the stochastics, which is this over here, this bottom thing that you see, can you see an 80 here? 80. And can you see a 20 here? So the 80 is the upper boundary, 20 is the lower boundary. And it works, again, similar to the Bollinger Bands. So every time, now do you see these two lines here, a blue line and a red line? Can you see the blue line and red line? Okay. One line is called the percentage K. The other line is called the percentage D. Now, that's not important to remember. All you need to know is when one or two of the lines go below 20, like this, what does it mean? When the lines go below 20 means it's over what? Over what? Oversold, ready to snap up, okay? And when the lines go above 80, it's over what? Overbought, ready to come down. There you are. Simple. All right. So let's see a few examples. Now here, is this overbought? Is this overbought? Yep. So you see it's starting to come down, right? Is this oversold? Yep. Went up, right? Is this overbought here? Yeah. Again, overbought, did it go down? Yes, but it didn't go down very much. It went down only a bit and then went up again. So again, it can't tell you how much it will go down. It just tells you you're likely to go down, right? So in this case, went down just a bit and then went up again and then got overbought again. And then this time it was a big drop all the way down. Okay. Same thing over here. Oversold and bounce up, right? This is not really counted because, yeah, it was not really out there. Yeah. This also not really counted. This one was overbought, right? Overbought. So it did come down, but just a bit, and then it went up again, right? So this did not really work out. This was oversold, and so it bounced up. Can you see that? All right. So slowly, I show you how we build a certain strategy. Okay. So we've got Bollinger Bands, and now we've got stochastics. What if we combine the two? Will that increase our probability? Yes or no? Yes. So let's combine the two. Let's put in both at the same time. There. Okay. And not only that, but I've also put in these moving averages. Can you see these moving averages here? These like lines, these are called moving averages. And we'll talk more about moving averages later in a while. Okay. I just want you to pay attention to the Bollinger Bands and the stochastics. All right. So if we wait for both the Bollinger Band and stochastics to be oversold together, would that be higher probability? Yeah, right. So for example, in this case, this was oversold on the Bollinger Band and also oversold on the stochastic. So is this a high probability reversal point? Yes. Okay. Now, is that enough? Can we just say, okay, Bollinger Bands oversold, stochastics oversold, buy? Is that good enough? No, not good enough. We need to add another thing to give us an even stronger case that is going to go up. What else can we use? What else can we use? You tell me. ATR? Not really. RSI? Well, RSI is another oscillator. So if you put in RSI, you know, two oscillators is enough. MACD is another oscillator. So there's no point putting more oscillators. It's like you put salt and you put soya sauce and you put MSG, you know, too much, you know. Let's see if any, oh, someone gave the answer. Okay, that's right. So the next thing that you can use to give yourself more evidence that it's going to reverse is to look for bullish candlestick pattern. is to look for bullish candlestick pattern. In other words, you only enter a buy when you see a bullish candlestick pattern. Now, there are many candlestick patterns, many of them. So I'm just going to talk about two right now. First is what we call the bullish pin bar. Okay, this is called a bullish pin bar. When you see a small body and a long tail, this is a bullish pattern. It's a bullish pattern. Okay, now the color doesn't matter. It can be green or it could be red. It doesn't matter. They are both considered bullish patterns because it's got a long lower tail, right? Or if you simply just have a big green candle like that, this is also a bullish candle. So it can be this, can be this, can be this. Now, sometimes you may see something like that. This is what we call an ice cream bar, okay? Where it looks like this, except it's got a fatter body with a smaller tail. It looks like an ice cream bar. But this one must be green color, right? The only one that doesn't have to be green is the small body long tail. That one can be red or green, it doesn't matter, okay? So in other words, not only must we have Bollinger Band and stochastics oversold, but one of these candles must appear, okay? One of the candles must appear. If we don't get a bullish candle, we don't take the trade. All right, very good. So now we have got three evidence for our case. We have got Bollinger Bands, stochastics, candlestick pattern. Now we want at least a fourth one. Any ideas? Doji, no. Doji, no. We can't use Doji, is not powerful enough. Okay. What else can we use to increase the case? Yeah, volume, you could use volume, but I don't really use volume for reversal patterns. Okay, very good. Some of you are giving the answer. The next thing that I want to look for is I want to ensure that I'm entering at a strong level of support. I repeat, I'm entering at a strong level of support, a support level. Okay. Now, the support level that I'm looking for, right, could either be from a moving average. That means the price is hitting a very strong moving average. Okay. Or it's hitting a very strong horizontal support level. Or my favorite one is I want to see a double bottom pattern. A double bottom pattern. Now, you can have either one of these three to confirm the reversal. But my favorite is the double bottom pattern. This, I find, is the most powerful pattern. I hear some noise. Can someone just switch off mute their mic? Thank you. Someone out there. Okay, great. Now, let me explain what is a double bottom pattern. Yeah. So far, you guys following me? Okay, so a double bottom pattern is basically like this, where the price goes down and makes a low, right? So this is a low point. Let's draw an imaginary line here. This is an line, okay? Then what we want to see is the price goes down and then goes below that first low, right? Goes below it and then closes back above it. It should go below it and close back above it within 3 candles. Within 3 candles, okay? And I'll give you some examples later on. And after it closes back above it, then we want to see a bullish candlestick pattern, right? So again, it could be a big bullish candle like that, or could be an ice cream bar, or could be a bullish pin bar. You know, either one of this here. Now, why is this a very powerful pattern? Because what happens is that when the price comes down here initially and it starts to go up, there are a lot of traders who bought here, right? A lot of traders who bought here. And when they bought here, what did they do? They placed their stop losses here. And you can see there'll be a lot of stop losses that are placed by these traders over here. Now, the market makers can see your stop losses. And market makers, they love to hunt people's stop losses. So what they do is oftentimes they will purposely drive the price down using bad news as an excuse to go down and hit these stop losses. So when these stop losses are hit, these poor retail traders are forced to sell their stock. Now, who buys the stock? When these retail traders, their stop loss get hit and they end up selling, who buys? Who buys? The market maker will buy, right? So the market maker will pick up all the stop loss. And now that the market maker has picked up all their shares, the market maker is then incentivized to push the price up. And this is something that you guys learned on the first day by Elson, right? Price action manipulation. So this pattern plays out in this scenario. That's why we love this double bottom pattern. It is also called a shakeout pattern. Market makers, they shake out the retail traders, shake out their stop loss, and then collect their shares and write it up, right? Now, the opposite happens, of course, on the other side, where the price goes up, makes a high, comes down, and this is, again, the previous high. And then if you see the price going up again, goes above the previous high, and then closes back below it within 3 candles. That is called a double top pattern, right? So this is a double top. This is a double bottom, okay? So this is a high probability that your price will tend to go down. There's a high probability price will tend to go up. All right. So if you combine all 4, lower Bollinger Bands are hit, low stochastics are oversold, you got a double bottom pattern, you got a bullish candlestick pattern, you got 4 of these at the same time, does that give you a pretty good probability that price will tend to reverse? Yes or no? Yes. Right? So that's the slingshot strategy. Okay? That's the slingshot strategy. So let's look at a couple of examples of the slingshot strategy. So the first is on AZO. Now, again, this could appear on any type of stock. Could be a high price stock, low price stock, any type of stock. Okay. Can this also appear on ETFs? Can this appear on Forex? Yes. Can it appear on gold? Can it appear on oil? Yeah. Anything that has a price, or even cryptocurrency. Yeah. Anything that has a price, you can use this setup. Okay. So if you take a look at AZO, I entered this trade here. Can you see this setup over here? So first of all, the price went down, okay? And then you can see it's oversold. It went below the lower Bollinger Bands. So price pierced lower Bollinger Bands. That's the first entry rule, okay? And the stochastics is below 20, oversold. That's the second entry rule that's met. And the third one, is this a double bottom pattern? Is this a double bottom pattern? Yeah. This was the first low. This is the second low. Can you see this double bottom pattern? Shaking out the stop loss here. Market makers force the price down and shake out the stop loss and then incentivize to push the price up. Okay. Next, do we have a bullish candlestick pattern? Is this a bullish candlestick pattern? Yes or no? That is a bloody big bullish candlestick pattern. That is a bullish candlestick pattern, right? So once you've got this set up, then you can enter the trade. So for trading, I always enter with 3 orders at the same time. Always enter with 3 orders. Your entry, buy order, stop loss, and profit target. We enter it at the same time. We call it a bracket order, right? And of course, in the stock trading course, you will learn the mechanics of how to enter these bracket orders. Yeah, I won't go into detail today. If not, it's going to take too much time. But the general idea is that we will buy, okay, or rather I'll buy right above the bullish candle. So I have to wait for the bullish candle to close first. Now, if it's a daily candle, that means I have to wait for the candle to close and then enter the next day after the candle closed. I don't enter during midday when the candle is not closed yet, because if the candle is not closed, the green candle by the end of the day may turn into a red candle. You never know. You have to wait for the candle to close to confirm it, right? So in this example, I put my buy order right above this candle at 2441, right? Now, where do I put my stop loss? Now, remember, in trading, there's no guarantees. There's no guarantee it's going to go up. Could it still go down? After you buy, could it still go down? Yes. Remember, one night stand, you're going to use protection, right? Or if not, something can happen, right? So where do I put the stop loss? Very simple. Put a stop loss just below the low of that candle, the swing low, right? So in this case, our stop loss is at 2375. Now I buy at 2441. I put a stop loss at 2375. What's the difference? What's the difference between these two prices? The difference is $66. And we call that 1R. Remember, very important, we call that 1R. What does R represent? What does R represent? R represents risk, okay? Is the risk per share. So every share you buy, you are risking $66. Now in trading, we always want to make sure that we risk $1 to make more than $1, right? We call it the risk to reward ratio, right? So usually we want to risk $1 to make $2 on average. Now, sometimes if the market is not strong, we're more conservative. We could risk $1 to make $1.50, no problem. If we are very bullish, we think the market is like really running, we could risk $1 to make $2.50. It depends on the state of the market, right? Right now, the market is pretty strong right now, so we could risk $1 to make $2, right? So if I'm risking 1R, I want to make at least 2R. So what is 2R? 2R is 132. $66 times 2, 132. And my profit target will be 132 above 2441. So my profit target will be 2570, right? So once you place the order, and if the market goes above the high of this candle, your order will get filled. So in this case, the order got filled here. And then 1, 2, 3, 4, 5, 6, 7. On 7th day, it hit the profit target. Okay. Now, will there be times when after it hit the profit target, you get out of the profit and the price still keeps running? Will that happen? Yes. So should you have any regrets? I regret, I sold, I should have held it. Should you have regret? No. Have no regrets, because you can't predict where it's going to go after you got out, right? It could have gone down. You never know. Okay. So psychologically, always tell yourself, once you exit a trade, don't look at it anymore. Once you exit a trade, do not look at it anymore. It's like once you break up with your girlfriend or boyfriend, do not find out what they're doing. Delete their Instagram, delete their Facebook. Don't look, right? Because if you break up with the girl and then she marries a multi-millionaire, you will then want to kill yourself, right? Or if you break up with the boy and he wins the lottery, you're like, don't look, right? Whatever happens to the stock after you exit is none of your bloody business, right? So this is all about psychology of trading. Understand? Can we set a stop, trading stop, trailing stop? Yeah, you can do that as well. But the problem with trailing stop is oftentimes, right, you'll go down, hit a stop loss, and then you don't get as much as if you just take profit at the high. That's what I find. Yeah. Okay. Now, here's the thing. The slingshot strategy, I primarily use it when the stock or the market is in a broad consolidation phase. Okay, what do I mean? Okay. By the way, before I move on, take a look at this AZO here. Do you notice the moving averages? Can you see these moving averages here? Are the moving averages sloping up nicely in sequence, or are they all jumbled up? Can you notice they're all jumbled up? The moving averages are crisscrossing. Can you see that? It's like all jumbled up. So that tells you that the stock is in a broad consolidation. When moving averages are jumbled up, crisscrossing, the stock is in a broad consolidation, and that's the best time to trade the slingshot. Okay, so you have to understand that stocks move in different phases. So every stock goes through 4 stages. Yeah, the first stage is what we call stage 1. Stage 1 is the broad consolidation phase. So this is the phase where the stock price tends to go up, go down, go up, go down. It's like there's no clear trend. It's like very erratic, right? And the moving averages, they tend to be moving sideways or crisscrossing. This is the broad consolidation phase, all right? And this is the time when you see a lot of slingshot setups. Understand? Okay. Now, will the stock remain in a consolidation forever? No. Eventually, it will go into stage 2, which is called the uptrend phase. So on an uptrend phase, now you may say, how do I know it's up? How do I know it's stage 2? Very simple. How do you know? Look at the moving averages. When you see the moving averages, they start to be in sequence, especially when the 50, this is the 50 moving average, the blue line. Huh? The 50 is above the 150. 150 is the green line, and the red is the 200 moving average, right? So when you see the 50 above the 150, 150 above the 200, and they're kind of like sloping up nicely, that's a stage 2. That's a stage 2 uptrend, okay? So for stage 2, we use different strategies. We don't really use the slingshot. We use different strategies, which I'll talk about later on. We use the trend retracement. We use the breakout from base, breakout within base strategy for stage 2, all right? Now, then a stock can go into stage 3. What is stage 3? Stage 3 is what we call the topping phase. This is when the price starts to go up 90 degrees very sharply. It goes up like that, very erratic. So when you see the price start to go up 90 degrees, come down, go up again, it means that the uptrend is topping off, and it tends to start to reverse back down. Okay, so usually when we see the topping pattern, what strategy do we use again? When we see the topping pattern, what strategy do we use again? We use the slingshot, but this time we use the slingshot reverse, where we are now shorting the stock. And I'll give you some examples in a while. In fact, I'll give you an example in the next slide, right? Then the stock can then go into a downtrend phase. So downtrend will be, again, a different set of strategies, right? So that's why in the stock trading course, you learn different strategies, because different strategies will apply when the stock is showing different patterns, right? So in a certain pattern, you look for certain setups. You look for certain strategies to trade it, yeah? Now, so let me give you an example. Oh, okay, before that, let's look at some more examples of the slingshot long setup, right? The slingshot long setup. So this is Lululemon. And there was another setup recently that I took. In fact, I traded this using options, and it was actually notified to my students as well a couple of months ago. Okay, so this is Lululemon, and over here, can you see the pattern here? So price goes down and goes below the lower Bollinger Bands, so oversold on Bollinger Bands, right? Stochastics went below 20, oversold here. And then again, we have a double bottom pattern. This was the first swing low, and this is the second swing low. Can you see that? That's a double bottom pattern, which shakes out the stop losses. And then we close with a bullish candlestick pattern. Ta-da! Okay? Can you see the setup? Right? So once you see the setup and you know that there's a high chance it will reverse, you can just buy the stock. Now, of course, if you learn options like yesterday, you can use many different option strategies as well. Like you could use cash secure put. You can use bull put spread. You can use bullish synthetic, right? You can use many different option strategies, right? Or yesterday, Bang taught his Jade Lizard. You can use a Jade Lizard as well, right? So they all have different pros and cons, yeah? Okay, so if you're trading the stock, very simple. Just buy above the high of the bullish candle. In this case, you buy at 368.88. Stop loss put right below the swing low at 354.56. So what's the difference? The difference is 1 R. So R is the risk per share. So what's your risk per share? $14.32. So if I'm risking 1 R, I want to make 2 R. Okay. So Anup is asking, how do I find stocks with such possibilities? We use a scanner. We use a scanner, which I'm going to show you in a while, the scanner, right? And then we've written all the codes to screen for the setup every day. Yeah. If you missed the last 2 days webinar, watch the replay. You'll be sent a limited time replay. Yeah. Okay. So this example, we take profit at 397.52, right? And let's see what happened. So in this case, the price went up 1, 2, 3, 4, 5, 6 days. It went up. In fact, the price gapped up, right? Way above your profit target. So there'll be times when the price gaps up way above your profit target. So you end up making more money than you thought you'd make. We call this lucky, all right? Now, will there also be times that sometimes the price can suddenly gap down below your stop loss and you lose more than you thought? Could that also happen? Yes or no? Yes, we call that unlucky. Or in Singapore, we say sway. When it gaps up above the profit, we make more than we thought, we say heng. So one thing about trading is that in the short term, sometimes you're lucky. Sometimes you're unlucky. And it's not something you can control, right? But over the long run, as you keep trading every day, every week, every month, over time, it's not about luck. Because over time, the good luck and bad luck will cancel off each other. So that over time, your profitability is nothing to do with luck. It's based on statistics. It's based on statistics. Understand? Yeah. So don't be too sad if you are unlucky. That, oh, the price suddenly went down and I hit the stop loss more than I lost, right? Don't be upset. And if the price suddenly goes up and you make a lot more than you thought, don't be happy as well. Because in the long run, the good luck and bad luck, they cancel off. Got it? Yeah? It's about the system, the statistical system. Perry, in the stock trading course, I have a lesson on day trading as well, but personally, I do not day trade anymore. And in fact, Alson himself used to day trade in his prop firm. He doesn't day trade as well because we find that nowadays, day trading is not easy anymore with all these high frequency algos that are shaking up and manipulating the market. And there's a lot of time that you have to spend day trading, a lot of hours, and it's not as lucrative. So that's why nowadays we don't day trade, right? We focus on swing trading. We find it much easier, much more profitable, win rates much higher. We don't really day trade really. Yeah. Okay, let's look at one more example, pool. Okay, so pool, again, pool drop here and went below the lower Bollinger Bands. So Bollinger Band oversold, stochastics oversold. Do we have a double bottom? Yep, that was the first swing low. That's the second swing low. And this is a bullish pin bar, right? We've got a bullish candlestick pattern. So again, it meets all the criteria. So same thing, right? We put our buy order there, 351.10, stop loss right at the swing low, 344. What's our risk? $7.10 per share. We risk 1 R. Our profit target should be roughly about 2 R at 14.20, right? We take profit at 365.3. Okay. So this trade, it went up 1, 2, 3, 4, 5, 6, 7. Yeah, it took about 7 days to hit the profit target as well. Okay. How do we get access to the scanner? Yeah, so when you enroll in a stock trading course, you will get all the scanning scripts that have been written by our programmer that will help to scan for all these patterns, right? Question, isn't this a double top? Well, was there a double top? Yep, I think there was a double top here. Yep, very good. This was a double top. Yes, yes, yes. Correct, very good, right? So this was upper Bollinger Band, hit, stochastics overbought. We have got a double top, right? And we got a bullish candlestick pattern and went down. Very good. That was a double top pattern or a slingshot short setup, okay? And then we have a slingshot long setup. Okay, so talking about the scanner, all right, so let me show you the scanner. Now, you can use the scanner on Thinkorswim. If you have got access to Thinkorswim, there's a free scanner on Thinkorswim. Or if you don't have access to Thinkorswim, you can use another software called TC2000, right? Telecharts 2000. So I use both TC2000 and I use Thinkorswim, okay? And what I do every day is before the market opens, I will scan for the different strategies. Now, again, remember, I trade many strategies. Slingshot, breakout within base, breakout from base, trend retracement. I look for different strategies, okay? So every strategy has a different scanning script, right? So let me show you the slingshot script. Yeah. So can you see this? Can you see these words here? So this is the script that we have written to find this setup, right? Where the Bollinger Bands are oversold, stochastics oversold, right? And then the software will find these patterns every day in a few seconds, all right? Now, so every day before the market opens, I run the scan. Now, it so happens today when I ran the scan, there was nothing, okay? So it's like that. Certain days, there's no setup, no setup, no setup. Then certain days, you get a lot of setups. It's like fishing. You put the fishing rod into the pond. It's not that you always get a bite, right? But when you get a bite, then you pull on the fish. So for today, let me show you when I did my scanner, nothing came up today. Why? Very simple. Because if you look at most of the stocks in the market, most of the stocks are going up, right? Most of the stocks are going up. They're not going down. So usually the slingshot is after it goes down, then you get into reverse, right? But now the market, everything already went up. So we have to wait for the market to drop. Then we have a lot of slingshot setups. So let me show you. I'm going to run my slingshot setup right now. I'm just going to put in slingshot. Okay. And only one stock appeared. Only one. Okay. Now, just because it appears in a scanner doesn't mean it meets all the criteria. You got to still manually check, is there a double bottom? Is there a bullish candlestick, right? So if I just click on this one, which is CG. Hey, why is it not appearing? Ah, there we are. Okay. CG. So you can see that this appeared, only one stock appeared on my scanner today. And you can see, yep, it hit the lower Bollinger Bands. Can you see that? Hit the lower Bollinger Bands, right? And stochastics was a bit oversold, but not really a lot. So this is not a very strong oversold, right? Not very strong oversold. Just went down a bit, which I don't like. I like it to go down a lot. And this was also a bit not very good. And at the same time, do I have a bullish candlestick pattern? Do I have a bullish candlestick pattern? No, I don't, right? So there's no bullish candlestick setup. And if you look at the price going down like that, it's not very powerful. We like the price to go down sharply. Normally, the sharper the price goes down, the faster you rebound up, right? So this is not a nice setup. You understand? So what happens every day is I'll use a scanner and it will then show me all the stocks that have got the potential setup. And then I will see if any is good to trade. Some days there's nothing to trade. Some days there's a lot to trade, right? Today, nothing came up. So I can't really show you anything today. Nothing came up today, yeah? How about Cigna Group? Cigna, okay. Someone says signal group, is it? Is there a setup? No setup, right? You can see it did not touch the lower Bollinger Bands, right? This is also not very oversold, so no, there's no setup over here. Okay. Which stockbroker do I use? Oh, this scanner is called TC2000, but you can also scan it on Think or Swim as well, right? You're asking about Walmart, eBay. No, there's no point me checking Walmart or eBay. You know why? Because if there's a setup that was on Walmart and eBay, it would appear on the scanner. So the fact that it did not appear on the scanner means that there's no setup, right? Because this scanner will find all the stocks. Obviously, there's no setup. Yeah. Okay. However, like I said, right now the market has gone up a lot. That's why there's no slingshot long setup. But could there be some slingshot short setups? Could there be some slingshot short setups? Yeah, that could be, right? So what's a slingshot short setup? Let's take a look. So again, remember that when a stock is in stage 3, the topping phase, right? When the price goes up like that, right? Then it may start to come down. Okay. So this is where we can look for the slingshot short setup. What does it look like? It looks like this. This is the slingshot short setup, which is the opposite of the slingshot long setup. So for the slingshot short setup, we are looking to short sell. We're looking to short it as it goes down. So what's the entry rules? Number one, we want the price to be overbought, right? The rubber band overbought, ready to come down, correct? So first, we want to see the price out of the upper Bollinger Bands. We want the stochastics to be above 80. We want to see a double top pattern and a bearish candlestick, which is the opposite. So if you take a look at Netflix had a slingshot short setup during the topping phase before it went down. Okay, so can you see over here? This was the first high and then the second high. Can you see this double top here? Double top. And this is a bearish pin bar because it's got a long upper tail. So bearish pin bar is a small body with a long tail. The color doesn't matter. It could be green or red. If it's got a long upper tail, it's a bearish candle. Okay. Or if you see a big red candle, that is also a bearish candlestick pattern. Or if you see a inverse ice cream bar, that's also a bearish candlestick pattern. So if you either see this or this or this, that will confirm the trade. Yeah. So in this case, we have got this one, bearish pin bar, right? So does it meet all the criteria? Yeah. Stochastics overbought, above 80, upper Bollinger Band hit. So we enter a sell here, right? We sell below the low of that bearish candle at 686. And then if it goes down, we make money. If it goes up, we lose money. So we have to put a stop loss above the swing high at 701. What's my 1R? Do I scan for FX and crypto? No, I just focus on stocks. With stocks alone, there are a lot of opportunities. Okay. So in this case, my 1R is $15. Okay. And then my profit target would be 2R, right? $30 below at about 656. So you can see after this, you went on 1, 2, 3, 4, hit the profit target in 4 days. Can I trade currencies with Slingshot? Yeah, you could. How do we short sell a stock? Okay. It's all in detail in the stock trading course, right? I can't cover that here because that's a bit basic, right? And they'll just take too long. Today, I'm just going to show you the setups And of course, in the stock trading course, we go into detail. How do you enter a short setup, how to enter a long setup, how to put a bracket order, stop loss, profit target, is all in detail. How to use limit orders, stop limit orders, good to cancel orders, day orders. You need to know all these details before you start trading. That's why we have got the stock trading course. That is many hours of lessons to give you all the tools and all the knowledge to trade well. Yeah. All right. Useful so far, everyone? What is my capital amount per setup? Very good question. We'll be coming to that later where I talk about position sizing. How many shares to buy? That's coming up. So hold on. All right. So let me carry on right now. So like I said earlier on, the slingshot works best in stage 1 and stage 3. Right? When the stock is in stage 2, that means it's on a very strong uptrend, then we use different strategies. So what strategies do I use when it's on a strong uptrend? Now, first of all, how do we know when the stock is on a strong uptrend? How do we know? How do we know when the stock is on a strong uptrend? Okay. Now, let me give you an example of Meta. Meta is on a very strong uptrend. Okay. So okay. Very simple. Now, what I do is I use moving averages, right? Now, I basically use 5 main moving averages, okay, which I'll just tell you very quickly. The 20 EMA, exponential moving average, which is this red line, red dotted line. The 40 EMA, which is the blue dotted line. And then this blue line is the 50 simple moving average. Okay. This green line is the 150 simple moving average. And the red line is the 200 simple moving average. So altogether, 5 moving averages: 20, 40, 50, 150, 200. Okay. So how do we know when it's on a very strong uptrend? When these are in sequence. These moving averages must be in sequence. That means 20 must be above 40, 40 above 50, 50 above 150, 150 above 200. When they're all in sequence, that means the trend is very strong. Understand? Very simple. That's it. Okay. So when we have got all the moving averages in sequence, that means we're in a stage 2 uptrend. When we're in a stage 2 uptrend, we want to be a buyer because the uptrend is very strong. We want to buy to ride the trend. Correct? Now the question is, where do we enter? Where do we enter during a strong uptrend? We want to enter during what we call a low risk entry point. A low risk entry point. There are altogether 4 low risk entry points, depending on the pattern, right? So what are the 4 patterns? Let me introduce you to these 4 patterns right here. Let me do a bit of drawing first. What is the duration of the candle? The candle are all based on daily candles, right? Okay. So the first pattern that you may see on a strong uptrend is this pattern. Okay, this is the pattern that you see. So sometimes a stock, what happens is that this is one of the moving averages, right? This could be, for example, the 50 moving average. Okay, or could be the 20 or the 50, depending on the stock, right? Now, sometimes you will see a stock doing this pattern. It will move like that, wave up, and then wave down, and then it will hit the moving average and then bounce up. And then wave up, wave down, hit the moving average, bounce up. And then wave down again. How many of you have seen this pattern before? Where the price, it bounces off the moving average. Have you seen that? Okay. So this is what we call pattern number one. When you see this pattern, you wait for the price to retrace, to drop to the moving average, and it must hit the moving average and form a bullish candlestick pattern. So it could be a bullish pin bar like that, right? Or it could be a big bullish candle like that. Oops. Right? So once you see that, price hits the moving average, bullish candlestick pattern, stochastics oversold, then you buy. Then you enter here. Okay? And your stop loss is here. And then once the price wave up, you take profit here. This is the first setup. This setup is called trend retracement. It's called the trend retracement setup, right? So in the stock trading course, there's a whole lesson just on this pattern, where you learn every single entry exit rule of this pattern. So here's an example of what the pattern looks like. Here. This is a typical trend retracement pattern, right? So again, can you see? The price wave up, then wave down, hit the moving average, wave up, wave down, hit the moving average, wave up, wave down. So the moment you see that it keeps bouncing off the moving average is being supported, is being respected, right? So once it hits the moving average and you see a bullish candlestick pattern, which is testing the moving average, once that candle closes, you enter a buy, you put a stop loss there, and then there's a very high chance the trend will continue. And then you take profit before the next retracement. Can this appear on a weekly chart? Yes. Weekly chart, daily chart, it can appear on any time frame. Do I prefer to use stochastics versus Williams R? No difference. You can use either one. They are exactly the same. It's like Burger King and McDonald's. It's just a different brand. They're both burgers. Yeah, they both make you full. Okay. Do I sometimes modify the MA to 45? No, I never modify. These are the MAs I've used for the last 20 years. Okay. I never changed the MAs. So do we understand the first entry point, the trend retracement? Are you all clear on this one? Okay. Now, let's now look at the second low risk entry point. Okay. So the second pattern is called the breakout from base consolidation pattern, right? It's called the breakout from base consolidation pattern. So first, what does this pattern look like? First, the price is on this uptrend first like that. Okay. 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 So first it's on this uptrend, and then what happens? It hits a high here, and then it pulls back, and then it goes up, hits the same high, and pulls back again. Right? Then it's the same high, pulls back again. Okay, and it keeps making the same high. So it forms a resistance here. Okay. And this resistance must be tested at least 3 times. So this is 1, this is 2, and this is 3. At least 3 times. It can be 4, it can be 5. And the more it is tested, the stronger it will be when it breaks out. Right? Now, when the price finally breaks above this line, where it closes with a bullish candle, right? When you've got a bullish candle that closes above this resistance line, that's called a breakout pattern, right? So once we have got that bullish candle, we enter a buy. And you can put a stop loss somewhere here. And then that's when the price would tend to run. So this is called the breakout from base pattern. Right? We call this a base. This is called a base, right? So the price goes up, makes a base, and then breaks out from the base. So think of it like a prisoner who is trapped in this prison. He can't get out, he can't get out, he can't get out, he can't get out, he can't get out. And then one day the gate is open, what happens? He will run as fast as he can. And that's when you want to get on that train. Okay? Yeah, so Jack, is it Jack? Yeah. So Jack, you want the price to break above that resistance on high volume. So this is where volume is very important. So for this second pattern, the price has to break above the resistance on very high volume. That means there's a lot of institutions that are jumping in to accumulate the stock over here. All right. So let me give you an example of what it looks like. There. This is a breakout from base consolidation pattern. Now, again, notice something, guys. Notice, are the moving averages always in sequence? Are the moving averages in sequence? Can you see the 20 above the 40? Can you see the 50 above the 150? Can you see the 150 above the 200? Right? They must be in sequence. Okay, upon entry, they must be in sequence. 20 above 40, 50 above 150, 150 above 200 in sequence, right? This is one. Now, there are many ways you can see this pattern, right? One common example is like that, where the price goes up like that, like that, like that, and then break out. So there's a big base, medium base, and small base. This is one very common pattern that you see. Okay. Another common pattern you see Another common pattern that you see is like that. The price goes up, then it goes down like that, and then does this. Now, does this look familiar? Does this look familiar? What is this? Like that. This is called a what? Double bottom shakeout, right? Now, after this double bottom, usually what happens is that you'll make another smaller pullback here, and then you will break out. Now, I know it looks a bit like a penis, right? But it's like that, right? So double bottom and a smaller pullback, and then breaks out. Okay, so these are the common patterns that you see. So if you look at this one, can you see this pattern here, right? Can you see it made this here, right? And then it made a double bottom here, and then the third one, and then breakout. That's a breakout. Can you see? So this is the penis pattern. This is the tree lump pattern. And when you look at charts every day, you start to notice these patterns that happen, right? Okay, let's look at the third one. The third pattern is actually one of my favorites. One of my favorites that I often trade. Okay, this third pattern is called the breakout within base. Breakout within base. So this is what it looks like. The price goes up like that. And then the price then drops into a base like that. And usually this base is where the price would drop between 15 to 25%, right? And then it merges out of the base here. Then it makes a high, and then it pulls back from this high. Let's call this point A, right? It makes a short-term high, pulls back from the high, and then it closes above this high with a bullish candle. With very high volume, right? And this is where I will buy. right? This is my buy point. And then my stop loss is somewhere here. And then I will take profit somewhere here. Okay, so this is called the breakout within base pattern. So again, in the stock trading course, each of these patterns is a full lesson, with entry rules, exit rules, position sizing rules, and lots of case studies, and the scanner on how to look for these patterns before the market opens every day. Okay. How to determine where to take profit. So the simplest way to determine where to take profit is just set a fixed profit target of 2R. So wherever is your 1R, your risk, set 2R profit target and get out. That's it. Make your life very simple. Right? So there'll be many times when the price hits the profit target, you get out, but it keeps going up. Right? But there'll be times it hits the profit target, it comes down. You can't predict. So as long as you can risk $1 to make more than $1, that's good enough. You can't always like exit right at the top. No one is an oracle. They know exactly where's the top, right? No one can predict to that point. Yeah. Let me see. There was another question someone asked just now. Is this similar to a cup and handle pattern? Good question, Michael. It's a bit different because a cup and handle pattern is where the price must go up to the previous high here and then pull back, and that's a cup with handle. So this breakout within base, it occurs before this high. It occurs before this high point, right? It's somewhere in the middle before it reaches the high, right? So this pattern gets you in earlier compared with the cup with handle pattern, right? So let me give you an example of a breakout within base. Yeah. So this is a breakout within base pattern, right? So can you see again? First, you have a strong uptrend, moving averages in sequence, 20 above 40, 50 above 150, above 200, moving averages in sequence. Now, when the price goes into this base, can you see it goes into the base? When it goes into the base, the moving average, they cross, can you see the 20 cross below the 40? So the moving averages are no longer in sequence during the basing period, right? But when it starts to emerge from the base, right, it makes this high here, we call that again point A, and then it pulls back, and then it breaks out. This is the buy point. Right when is the buy point, the moving averages must be back in sequence, where the 20 must be above the 40, and the 50 must be above the 150, 150 above the 200. Then you get in, and then you write a trend up. All right? So again, I'm just giving you an overview, but the actual strategy itself, there's a lot of other things I look at. I look at volume, I look at volatility contraction. There's a lot of other stuff we look at, right? But giving you an idea about the different low-risk entry points. Now, the fourth and the last setup. Yep, so remember there is a Q&A I'll do at the end of the webinar. So don't worry if I miss your questions because I have to finish the lesson plan, and then I will take your questions at the end during the Q&A session. Yeah, so please ask the questions again if I miss your questions. So the fourth one is called the explosive breakout pattern. It's called the explosive breakout pattern. Now, this pattern tends to happen for smaller companies, not for big companies. The first three patterns are this one. 1, 2, 3 are for big companies, medium-sized companies, and small companies, all kinds of companies, right? But the fourth pattern is more for small companies that have a certain catalyst, like earnings catalyst, or is a drug company that invented a new drug or something like that, right? So in the fourth pattern, normally what happens is there's some catalyst that causes the price from going nowhere, the price suddenly shoots up. It shoots up by more than 90% within 2 months. So there's a strong catalyst that drives the price up, right? Now, let me say, why didn't you buy here? Now, of course, if I could predict the future and predict that they'll invent a drug, of course, I'll buy here, right? But I can't predict the future. I'm not an oracle. Okay? So I can't predict exactly the point where it's going to shoot up, right? But what happens is normally after an initial burst, what happens? There will be then what we call profit taking. And usually what happens after this strong run, the price would then drop like that, go up, drop like that, go up, drop like that. And it forms what we call a flag pattern. We call this a flag pattern. It's like a flag. This is a flagpole, and this is like a flag. Can you see the flag? And then it makes lower highs, lower highs, lower highs, lower highs. There is a resistance here, right? So this is the pattern I want to see. Now, once the price is able to break above this downward resistance on high volume, that's when I buy. Because usually what happens after this profit taking, you will do a second run. You'll do a second run. But I'm not greedy. I'm not looking for like a big move. You know, as long as I hit my profit target of 2R, I will take profit somewhere here. All right. So again, this is what it looks like. The explosive flag breakout. Okay. So again, you can see it's going nowhere here, right? Then you got some earnings, make very good earnings. The price run, whoa, right? And then it made a high, and then lower high, and then lower high. Can you see this resistance line here? And then it break out. And that's when you buy to get the second wave. So again, if you look at charts every day, I look at charts every day, and you see a lot of times the price movement is random, right? Going all over the shop, right? But there'll be days where you see these four patterns. There'll be days you see these four patterns. And when you see these four patterns, that's when you want to enter a trade because it's got a high probability that it will go up. Okay? How many of you are learning this for the first time? I'm just curious. Any of you learning this for the first time and you find it enlightening? That, okay, now I know what pattern to look for. Okay? Okay, cool. Now, let me teach you another one of my secret sauce. Right? How I get much higher win rates than most traders. Okay? Another one of my secret sauce is that not only when I trade, I want to look for stocks on a strong uptrend. Remember, strong uptrend, moving averages in sequence, right? 20 above 40, and then 50 above 150, 150 above 200, okay? Now, besides that, another thing that I look for to give me a stronger probability is that I like to trade stocks. Now, this is not the slingshot. Huh? Slingshot is when it's in a consolidation. I'm talking about these four patterns, right? So for these four patterns I just taught you, I like to trade stocks that have the highest relative strength. I like to trade stocks with the highest relative strength. Now, what does relative strength mean? What does relative strength mean? So let's say you have got a stock that goes up 10% in the last 3 months. Okay? Is this a strong stock? Does this stock have strong relative strength? It depends on what happened with the rest of the market. What if I told you that the S&P 500, the rest of the stocks, in the last 3 months, it went up 20%? Whereas this stock went up 10%. Then does this stock have high relative strength? Does this stock have high relative strength? No, it's got low relative strength because it is weak compared to the rest of the market. Okay, but what if I told you that stock A went up 10%? Oops. Stock A went up 10% in the last 3 months, whereas the S&P 500 went up only 1% in the last 3 months. This time, is stock A a very strong stock? Yes or no? Yes. So now you understand what is relative strength. So relative strength means the stock is strong compared to the other stocks in the market. Okay. Now, when you are doing momentum trading, the highest probability comes when you trade stocks with the highest relative strength. Let me say, how high is high? Okay. So generally, we want to trade stocks that are the top 15% in the market, the strongest 15% of stocks in the market, the strongest 15%. Now, how do we measure it? You see, how many of you realize that when the index goes up, the S&P 500 index goes up, not all the stocks will go up? Do you realize that? Do you think all the stocks will go up when the market goes up? No. In fact, I can tell you that on any given year, when the index goes up, only very few stocks contribute to the gain of the market. In fact, research has shown that out of 8,000 stocks and ETFs, okay, they found that the best performing stocks, that means the top 25% of stocks accounted for all the gains of the index. And 75% of the stocks in the market on any given year have a negative return. So it makes sense for us to only focus on the top 25%. But for me, I don't want to focus on the top 25%. I want to focus on the top 10, 15%. So I've got very strong stocks, okay? So again, a percentage of top 25% of the strongest performing stocks make up the majority of the gains in the index in any given year. We identify the top performing stocks with relative strength. All right. Thank you, Sean. Appreciate that. That's the bad news. The good news is that if you enroll in the stock trading course one time, all right, every Sunday, we will generate the list of the highest momentum stocks for you. And you get it every week, right? So this list is updated every single week. And we send it to our students every week so that you know every week you just focus on the list of highest momentum stocks. So let me give you an example of this list that we just posted in our stock trading Discord chat group under resources over here. There, we post this every Sunday. So let me click and open it up. Yeah, here's the list. Okay, can you see this is the high momentum list? ACGL, ACIC, ACMR, ACVA, Adobe, right? There, this is the list. Every week, the list changes. This list of stocks have the highest relative strength, right? So what I do with my students is that we will copy this list, copy. Is relative strength the same as RSI? No, and it's totally different. It's a different concept. It's a different, okay. So what I do is I will copy, right? Let me just copy, edit, copy, right? So I copy this list and then I will paste it into my scanner, all right? I'll click here, new watch list, and I'll call it 20th November high momentum list. Okay. And then I will paste the stocks, 300 of them, 302 stocks out of 8,000, right? So these are the 302 strongest stocks. I'll paste it in my watch list here. There, it's all here. Okay. Then once I have got this list, what do you think I do next? I'll then scan the list for those setups, for the breakout setups. Okay. So again, all this is shown step by step in the stock trading course. So if it's a bit fast, you don't catch it, don't worry. In the course itself, we'll go step by step on how to scan every day, right? So I will scan from this list of high momentum stocks, and I will scan for the breakout pattern here. And there, all the stocks will appear that I could potentially trade, right? And let me just show you some examples so you know what I'm talking about, right? So example, this one, okay? What pattern is this? What pattern is this? Remember, I showed you 4 patterns just now. Let me refresh your memory. Trend retracement, breakout from base, breakout within base, and explosive flag breakout. What pattern is this? Breakout from base or breakout within base? This is actually a breakout within base. Okay, it's a breakout within base because if it's a breakout from base, that means it has to be above this, right? This is within the base here. Okay, this is actually within the base. Okay, so you see the price went up here, right? And then it make a base. Can you see it make a base here? So now it goes up, it pull back, and if it can close above here with high volume, that could be a setup, but it has not yet closed above, so it's not yet right. It's not yet ready. I'm watching it. I'm watching it to see if it will break out, right? So what I do is I look for setups and then I watch it until the day it breaks out. Then I will get in if the pattern is valid, right? Show you another one, DRI. Okay, not this one. Yeah, well, this was actually a previous setup. Okay, who can tell me what previous setup was this? Trend retracement, breakout from base, breakout within base, or what? What was the previous setup that? Yeah, correct, guys. Trend retracement, trend retracement, right? Very good. Because this is clearly bouncing off the moving average, right? Wave up, wave down, wave up, wave down, right? Wave up, wave down, wave up, wave down. So bouncing off the moving average, right? This is a trend retracement setup. Very good. You're beginning to recognize the patterns. How about this one? How about this one? Okay, no, this was the old one. This was the old one also. It already flew off already. This was another breakout within base. Can you see? Right? This was a base. It hit the point A, it pull back, and then breakout. This is a breakout within base, yeah. Okay. How about this one? This is a potential breakout within base as well, right? So went up, build a base, but it has not broken out yet. Not yet broken out. So I'm watching this one as well. There are a couple of them I'm watching, but I don't see any ready tonight. Now, this was a previous trade setup. What trade setup was this previously? Trend retracement. Can you see it's bouncing off the 20? Can you see bouncing off the 20? Bouncing off the 20? This was a very good buy point. Buy here. Bounce off. This is bouncing off the 20 EMA. Okay. Okay. So in trading, is different from investing. Investing, we look for very good companies. We buy them when they're undervalued. Trading, we're looking for patterns. We're looking for patterns. We're looking for one-night stand. When a girl or guy is ready, right? And they have the pattern and we just go for the pattern and we have a stop loss. Yeah? Different concept. Okay. So again, every Sunday, we will generate the list for our community. For bouncing off the trend, may I know how to set up the take profit point? Now, again, to keep your life simple, whichever pattern, your take profit just set at 1.5 to 2R. That's it. Right? So if you, example, you buy at $50. If you buy at $50, your stop loss is at $45. Okay, what is your 1R? If you buy at 50, your stop loss is at 45. What's your risk? What's your risk? Your risk is $5, right? Your 1R is $5. So you take profit at $10 above the 50. So you take profit at $60. That's it. Keep your life very simple. Yep. Okay, so let's move on. What makes a profitable trader? If you want to be consistently profitable as a trader, whether you're trading options, you're trading Forex, you're trading crypto, doesn't matter, it's the same. To be a profitable trader, there are three things that you need. If you are not profitable now, it's because you lack one of these three things. What's the first thing you need? The first thing you need is you need a trading system. You need a trading system that gives you a positive edge in the market, that gives you a statistical edge in the market, right? Now, first of all, do you think that many traders, they trade with a system of strict entry rules and strict exit rules? Yes or no? No. I can tell you that most traders out there, when they trade, they don't have a trading plan. They don't have a trading system. They just get in or get out based on emotions. Oh, I think it's going to go up. Oh, I think it's going to go down. I heard on TV that this guy says gold is going to go up. I heard that this guy said that Apple's going to go down, right? So they trade based on predictions of people. They trade based on news. They trade based on rumors. They trade based on emotions. And that's why they always fail, because there's no system. So you must trade on a system of predefined entry rules and exit rules that gives you a statistical edge in the market. So example, the slingshot is a strategy that gives you an edge. Why? Because we enter when it is oversold, when it's a bullish candlestick pattern, when it's a support level, that gives us an edge. Will it guarantee it will go up all the time? No. But it will go up more often than not. All right? So trading system. So again, in the stock trading course, you will have the different trading systems you're going to learn. They will give you an edge. Is a trading system good enough? Is a trading system good enough? No. It only makes up 10% of a trader's success. Only 10%. So yes, it's very important, but it's only 10%. Why? Because the other two are even more important. So the second thing that's even more important than your trading system is what we call position sizing. Please write this down. Position sizing is more important than the strategy. Position sizing tells you how many shares to buy or how many shares to sell. It tells you what is the percentage risk you should have on your account in trading. Okay? Now, let me tell you this. You can learn the best trading strategy from the best trader in the world and still lose money if you do not size your position correctly. Let me give you an example. Let's imagine that you learn a trading strategy from the best trader in the world that has got a 90% win rate. Let's say, Now, is it possible that you could still go broke even if you learn the best trading strategy from the best trader? Could you still go broke? Yes or no? Yes. If you do not manage your money or position size correctly. So let me give you an extreme example. Okay. Now, if you have a trading strategy that has a 90% win rate, what does it mean? What does it mean? It means that if you take 100 trades, statistically, you will have 90 winning trades and 10 losing trades, correct? That's what it means. Now, here's the problem. The problem is you will never know out of the 100 trades when the losing trades will appear. They could appear at the start, they could appear at the end, they could come in a row. You don't know, right? It's random. But you know that in every 100, there'll be 10 losers. Or in 1,000 trades, there'll be 100 losers. Okay? Now, let's imagine you have got $10,000 to start trading. And you say, for my first trade, I will risk half my money. I will risk 5,000 because my strategy is 90% win rate. So great. I want to be a millionaire next week, right? So you risk $5,000, and it so happens that your first trade happens to be a losing trade. What happens? Now you lost 5,000, right? So your account from 10K now drops to 5K. But then you tell yourself, never mind, the first trade was a loss. The next one is bound to be a win because my strategy is a 90% win rate, 90% chance. The next one is bound to be a win. So I'm going to go all in. So you're going to risk your remaining $5,000. Don't laugh. There are people who do shit like that. Okay. And is it also possible that the next trade happens to be a losing trade? Yeah. And then you lose the next 5K. Guess what? You busted your account. You're gone. Now, what if I told you that the next 98 trades were all winners? But the trouble is you're not there to capture the winners because you just blew yourself up. Now, how many of you have done this to yourself before? How many of you know what I'm talking about? Right? So you get the point. The point is you can have the best winning strategy, but if you don't manage your money, you don't, size your risk, you could blow yourself out. So in a way that when the wins come, you're no longer there to capture the wins. Now, we know in reality, in trading, when you trade stocks, you think you can get a 90% win rate? Realistically? You think you can get a 90% win rate in trading stocks? No way. Okay, so realistically, what do you think is the win rate for a good trading strategy? What do you think is the realistic win rate of a good trading strategy? If you have been trading for many, many years, or you are a professional trader, you know that, okay, I see some of you say 70%, 65%. Okay. The reality is this. The best traders in the world for stock trading, their win rate is between 50 to 60%. Okay. And I can tell you that even the best traders in the world, even Alson Chu, who is one of the top traders who has made millions in crypto, his win rate with my win rate, same, is between 50 to 60%. That's it. And I can tell you that many professional traders will sell their grandmother, will sell their soul to Satan to get a 60% win rate. At a 60% win rate, you will make a fortune. In fact, even a 50% win rate, you will make a fortune if you manage your risk to reward the right way. Okay? So you must have that realistic expectation. If you take a trading class, you think, I'm going to win 90% of the time, I'm going to win 70% of the time in your freaking dreams. But then, I must say, if you use options, different, If you use options, yes, you can get a 70 to even 90% win rate on options. Different. Right? But that's because in options, you don't risk one to make two. You often risk you often risk a bit more to make a bit less. So there's always a trade-off, right? So while options has a much higher win rate, but sometimes your risk is a bit more than your gain. But ultimately, your win rate is very high. You still are very, very profitable. Okay? So I got to set your expectations right. Yeah? Follow everyone so far? Follow everyone so far? So let me teach you today how professionals size their position. Okay? How do you calculate the number of shares to buy? Now, here are a few rules I want you to remember. Rule number one, always risk a fixed percentage of your capital on any one trade. Okay, I repeat, always risk a fixed percentage of your capital on any one trade. So my suggestion is most traders, you should only risk 1% of your capital on any trade. Please write this down. Only risk 1% of your capital on any trade. Now, if you're more aggressive, 2%. If you're very aggressive, 3%. That's it. Don't ever go more than 3%. If you go more than 3%, you are insane. You are insane. Okay? I can tell you this. A 1% risk, you make a fortune already. You already make a fortune. Yeah? Now, so for the purpose of this example, let's assume that you risk 1% of your money each trade. Yeah? Now, the thing is, you got to be consistent. You cannot say, oh, this trade I risk 1%, this trade I risk 3%, this trade I risk 2%. No, it doesn't work that way. If you keep changing your risk per trade, it will screw up the statistics of your trading. You got to always maintain the same risk per trade and take only the high probability trades. Understand? Now, next, how do we calculate the number of shares to buy? This is the formula. Write this down. The number of shares that you buy or you trade is equal to your percentage risk per trade times your net liquidation value, which means your capital, divide by the risk per share. Okay, so let's go step by step. Now, again, in this example, what is our percentage risk per trade? What is our percentage risk per trade? 1%, very good. Okay, 1%. Now, what is our net liquidation value? This is the capital we have in our account. Let's imagine it is 10,000. Okay, let's just say. Again, could be 5,000, could be 1,000. Let's take 10K. So 1% times 10,000. What is 1% of 10,000? Very good. $100, right? Okay, great. So $100 is the most you can lose on a trade. It's the most you should allow yourself to lose on a trade if you have a $10,000 account. Okay. Now, then you take the $100, which is the total risk, divide by the risk per share. What is the risk per share? The risk per share is the 1R that you have calculated, which could be $66 or $5, whatever, right? So let me give you an example. Let me give you an example how to use this formula. So let's look at Lulu. Let's use Lulu as an example. Now, remember Lulu? This was a slingshot setup. So to recap, what's our buy entry? 368, right? What's our stop loss? 354. So for the Lulu example, what is our 1R? What is the 1R? What is the risk per share? The risk per share is $14. Got it? And our target price would be $28 above the entry, which would be $397. So let's imagine you want to trade Lulu. Okay? How many shares will you buy of Lulu? Okay, let's do step by step now. Again, let's assume you have got $10,000 in your account. Okay? And you're risking 1%. Right? So let's calculate what is 1% of 10,000 again? What's 1% of 10,000? 1% times 10,000 is $100. So listen carefully. The most you can lose is $100. Okay? That's your maximum loss per trade. So how many shares do you buy? So what you do is you take 10,000 times 1%, which is $100, right? You take $100 here, and you divide your total risk by your risk per share, which is $14. That gives you, ta-da, 7 shares. Now you understand? So you buy 7 shares. Now, if you buy 7 shares, what is your total position size? 7 shares times 368.88 is 2582. Correct? So out of $10,000, you use 2,500 to buy Lulu shares. That is your position size. Now, is 2582 your risk? Is 2582 your risk? Yes or no? No, 2582 is not your risk. What's your risk? What's your risk? Your risk is what? Your risk is what? Your risk is $100. Understand? So your position is not your risk. Remember that. Your position is not your risk. So if you enter this trade and the price hits your stop loss, how much do you lose? You would lose $14.32 times 7, right? You lose 14.32 times 7, which is $100, which is 1% of your money. Now, if it's a winning trade, then you make $28.64 times 7 shares, you make $200, which is 2% return on your capital. So can you see that how we play this game? We are risking 1% of our money to make 2% again. Can you see how we play this game? Okay. Now, when you enroll in the stock trading course, you will get a set of trading tools. So one of the trading tools you will get is the position sizing calculator. Is the position sizing calculator that looks like this. So you don't have to do it yourself. It will auto calculate everything for you, right? So example, you key in the boxes in white. The rest are auto calculated. So example, let's imagine you got $10,000 capital. Right? And your risk per trade is 1%. Okay, 1%. And your entry price, what's our entry price in this example? Our entry price is 368.88, right? So let's put that in 368.88. And our stop loss is 354.56. 354.56. And we are targeting a risk to return of 1:2. So put 1:2, right? And then straight away, tada, it will calculate how many shares to buy. How many shares to buy? 6.98, which you round off to 7 shares. Do you follow so far, everyone? Right. By the way, in this trading tools, you also get something very powerful called a trade simulator. Not stimulator, not erotic stimulator, simulator. So this is our trade simulator. And it will show you the statistics of your trading. Okay. So for example, let's say you put in $10,000 capital here, right? Put 10,000 here, right? And you have a win rate of just 55%. Let's say, let's be conservative, 55% win rate. Okay. And you risk 1R to make 2R. Oops, sorry, 2R. Okay. And you do 100 trades. 100 trades. 100 trades will take you probably like 6 months, right? Or even if you take only 10 trades a month, which is very low, in less than a year, you do 100 trades, right? But if you trade more frequently, then you could do 100 trades in 5 months or 4 months, whatever it is, right? Now, can you see that if your win rate is about 55% and the actual random trading result is 59% win rate, your compounded return is 113%. right? Your 10,000 grows to $21,000, right? Now, even if your win rate, let's say your win rate is only 50% win rate, okay? And the simulated win rate is 56%, you're still getting a 95% return, right? Now, let's get a really crap win rate. Let's say your win rate drops to 48%, right? You win less than half, but you risk 1 to make 2, you're still getting a 53% return. So this will help you to see the statistics of how trading works. Okay, whatever trading you're doing, whether trade stocks or Forex, this simulator will help you, right? You also get a trading journal as well. So to summarize what I've taught you so far, I want you to understand before you start trading, or if you're already trading and you're not doing well, is because you may have a lot of wrong expectations about trading. So what's the reality about trading? Now, a lot of people have this myth that successful traders are able to predict the price movement better than other people. They can predict exactly when the price will go up, when the price will reverse, when the price will go down. Is that true? Can successful traders predict the price movement better than other people? No, they can't. I can't predict the market better than you can predict the market. I'm not an oracle. I can't see the future. Okay. So what is the reality? The truth is that all we can do in successful trading is to identify high probability setups. That means we do not just anyhow buy a stock because we think it's going to go up, or we heard the news that it's going to go up. No, all that is complete rubbish. We enter a trade when there's high probability based on the technical patterns that is on an uptrend. The price is at a support level. There's a bullish candlestick pattern. It's oversold. That gives us a statistical edge. That's all we can do, right? But is it a guarantee that the price will go up after we buy? No, we can't predict. Sometimes it can meet all the rules, but the price doesn't go up. Price can still go down, right? Sometimes it meets all the rules and the price goes up. It's a probability, okay? The other myth people have is that, again, successful traders have very high win rates. They win all the time. That is an unrealistic expectation. So when you have got this unrealistic expectation, you will get very frustrated when you trade for real. And you think that something is wrong with you. Like, oh, why can't I get this high win rate? No, the reality is that successful traders win at the most 50 to 60% of the time. And like I said, if you can get a 60% win rate, you are among the best traders in the world. And you don't need a 60% win rate. You just need to win 50% and you will make very good returns. Okay? So the key to profitable trading is in managing your risk to reward. In other words, is to make sure that when you lose one, and when you win more than one. That's all you got to ensure. To have the discipline to cut loss so you lose one, and to take profit when you make more than your initial risk. And to size your position in a way that you only risk a small percentage of your capital on any trade, to only risk 1%. Why? Because shit can happen. You could have a losing trade. You could have 3 losing trades. You could have 5 losing trades. Everything is possible. So if you risk a small amount of your capital, even if you hit an unlucky patch where you get 3, 5 losing trades, it will not damage your account so that you live to fight another day. You understand what I'm saying? You must always live to fight the next day, because when the winning trade comes, you need to be there to capture the winning trade. Yeah. Before you start a business, you need a business plan. So you have to think of trading as a business. You need a trading plan. Trading is not gambling. Although a lot of people, they say they are traders, they are not traders, they are gamblers, because they've got no plan. They've got no statistics. They depend on luck. We don't depend on luck. We depend on statistics. Okay. So the trading plan is very simple. When we enter a trade, we have a fixed stop loss, a predetermined stop loss that we set, that we have to respect, and we have got a set profit target. And we ensure that when we have a loss, we risk only 1% to 2% of our money. But when we have a win, we win more than we risk. Okay? And the chance of hitting our profit target, again, realistically, is 50 to 60%, but there'll also be a 40 to 50% probability that we'll hit our stop loss. Okay? So you got to have the right expectations. Now, if you do 10 trades a month, that's 120 trades a year. If you have a 50% win rate, that means you will have 60 wins and 60 losses. Will you know when the win will come? Will you know when the loss will come? No one knows. Sometimes the wins could come first, then the losses. Sometimes the losses could come first, then the wins. Okay? But each time you risk 1% to make 2%. So 60 losses, each loss you lose 1%. 60 wins, each win you win 2%. Net, that's a 60% return per year, which is about 5% a month. Right? Is that better than fixed deposit? Now, what if you only have a 40% win rate? That means you will have 48 wins and 72 losses. But if you keep your risk to reward ratio, you lose 72%, you win 48 times 2, 96%. Are you still profitable? Are you still profitable? Yes. So the great thing about trading is you do not need to have a high win rate to make money. You don't need to. It's nice to have, but you don't need to. It's about controlling your risk to reward ratio, right? I love this email from one of my students, Kenny. And he said it exactly. He said, "Hi Adam, good day. It's been 9 months of live trading. I've officially doubled my initial capital, even though my hit rate, which is the win rate, is only 50%. I'm very glad I attended the Wealth Academy program last year. It was one of the few absolutely right decisions I've made. This equipped me with my recession-proof skill set," right? And this is one of my other students, Errol. And Errol actually trades on the Hang Seng futures, using the same approach. He said, "Adam, would like to thank you and let you know that your system works not only for swing trading, but also for intraday trading. My hit rate for Hang Seng is less than 50%, but I managed to triple my capital by using your system," right? So if you look at his results that he shared, he did 102 trades. He had 45 wins and 57 losses. 45 wins and 57 losses. His average loss was 1,001. His average win was 2,000. So net, he made 25,000, right? Adam, the 123 trades don't need to be on the same stock. No, of course it's not on the same stock. It's definitely not on the same stock, right? It's on different stocks, okay? Very proud of this guy, Eric Tam. Eric is from Malaysia, he's from KL, and he attended my class about 10 years ago, right? And I want to show you a video of him 10 years ago when he was still a student. Was he still a student? I think he was still a student, yeah. Or he just graduated. And now, of course, he's really a very, well, I wouldn't say old, right? But he's now a career guy. And he just posted his account on Facebook. And he's up 97% this year using these trading strategies, right? I'd like to share with you his video that he made like 10 years ago when he was still a very young student, and show you how far he's come since then. And that time he was only trading Malaysia stocks during that time when he first attended my class. So let me just play Eric's.
I began my WO program in year 2014, and
9 years
time,
ago.
I was buying and selling Malaysian shares, and it takes quite a long time. It takes about 1 month to 2 months. And only in year 2015, August, I started to trade US stock, is where the moment I make the most money out of a capital, which is about 5,000 US dollar, when the economy is crashing due to the interest rate hike. I would recommend all my friends who is very interested in the subject of finance and investment to attend this course, and also those who want to make extra income for themselves, for their family or whatever. Because whatever that you learn from this course is possible for you to make money. The reason I'm willing to spend this amount of money to attend this course is because I knew that after I learned, because I knew that if I'm able to learn and apply the strategy from this course, it benefits for my entire life. And I also understand that many people say that 5,000 is a huge amount of money, is a huge investment. I rather learn it by myself. And to me, yes, you can learn it on your own, but I would rather spend 5,000 to buy the time from a professional trader that has done it before with proven track record to learn it. So my learning curve will be reduced exponentially. By the time, because I use the money to buy the time and the knowledge, I'm able to do it faster than those people who think that they can discover themselves about whatever strategies that they think works in trade.
Right. So that was almost 10 years ago. Actually, it's 8 years ago. And after that, after 8 years, the guy is still trading really well. Right. So again, these are skills that you learn not just for 1 year or 1 month, but the next 10 years, 20 years ahead. These are skills. Right. This is Sahok, who just posted this recently. Thank you, Adam, Bang, and Alson, whole team, for your guidance. Up 123% year to date this year. Right. So some people ask me, could you trade for a living? And how much capital do you need to trade for a living? Well, it depends on how much you spend, right? So if you spend 5,000 a month, that means your annual expenses are 60,000. So how much capital do you need to generate the income from the markets for 60,000? So it depends on what's your asset. For example, if you put your money to fixed deposit, now it's about 3% fixed deposit rate. So if you take 5,000, sorry, if you take 60,000 divided by 3%, that's 2 million. So if you have $2 million, just put into fixed deposit, and then you get 5K a month, settle. No need to trade already, right? But you can still do it for fun, right? Now, if you put into bonds, right? Bonds or REITs, yeah, you could get 5%, and then that will be 1.2 million, right? But if you trade, and if you trade an average of 5% a month on average, if you target 5% a month, that's about 60% a year. Now, again, in full disclaimer, I'm not saying that all of you can definitely do this guarantee. You have to put in the work, the effort, the research, the practice to achieve this. Some of you will get much higher than this. Some of you may get lower than this. I can't guarantee, right? It is all up to you, how much effort you put in. But these are results that my students have proven over the years, right? And teaching this now for 15 years, okay? 100,000, right, is what you can possibly generate. Now, some of you may say, I don't have 100,000 now. How? Yeah, slowly build it up. You may have 2,000, 1,000, 5,000. Build that up slowly so that you can do that. But of course, understand that trading is not passive income. People say, oh, trading is passive income. No, it is not. It is active. You have to actively find the stocks, do the research, enter the trades. It is not passive, like put into fixed deposit. You have to put in the effort. I have to tell you that. Okay. So again, this is one of my other students. All right. I won't go through too much of that because there's so much that I am actually running a bit late, but never mind. I want to cover this part because I think this part is really important. So number one, you got to have a trading system, okay, with predetermined entry exit rules, okay. Number two, position sizing, which I shared with you the formula, and you will have the calculator to make sure that you size your positions correctly. But the third thing that you need is the most important, and that makes up 60% of a trader's success. Can you guess what it is? What makes up 60%? Deb, you are right. Mr. YK Wong, you are right. It is psychology. Psychology is the most important thing. That's why in a stock trading course, it's not just about the strategy, but I spend in the trading course the lessons to go through the psychology of trading. I spend a lot of time to help you to rewire your mind into that of a winning trader. Okay, so what does psychology mean? Now, you can have the best strategy in the world. You can have the best money management technique in the world, but you will not succeed unless you have the discipline. All right, write this down. You need to have the discipline to follow the system consistently without deviation. Is it easy? No, it is not easy. Because a lot of people, they don't follow the trading system. They deviate from the trading system because they are affected by what? Their emotions of fear, of greed, of frustrations, of impatience. I give you an example. So one of the things is you only take a trade if it meets all the entry rules. It must meet all the entry rules before you take a trade. But there are people who are impatient. They say, oh, you know, today I can't find any good trade, but the market is going up, so I just buy this, right? Or it doesn't meet the rule, but never mind, I bend the rule, right? Who's done that before? Right? You enter a trade that does not meet the entry requirements, but you take it because you're impatient, because you're trigger happy, right? Because of the greed, the impatience, yeah? Then some people, they enter a trade and they put a stop loss there, right? But then when the price goes down, they say, but it's going to hit the stop loss and I don't want to lose money. Remove the stop loss or shift it lower, right? And, you know, sometimes when you do that, yeah, the price could go up and you feel happy. But if you have the habit of doing that, there'll be one fine day you move the stop loss, get rid of it, and the price keeps going out. That one big loss can wipe out many of your wins and blow your account. How many of you that has happened to you? One big loss wiped out many wins, right? Or some people, they enter the trade, they put a stop loss, they put a profit target there, and the price is going up. I'm going to hit the profit target. But what if it keeps going up? I think it'll keep going up. So I raise the profit target or I remove it, right? And then the next thing you know, it drops and then the profit's gone. You know? Or some people, they start trading and they start to have many winning trades. They've got a winning streak. Right? They win, they risk 1%, they've got, you know, 10 wins in a row and they feel, I'm good. And they start to think, why am I risking 1%? You know, Adam is a chicken. Adam's a coward. He tell me only 1%. Oh my God. I'm going to risk 10%. If I risk 10%, I'm going to be a millionaire next week. And they risk 10% or 20%. And then they forget that after the winning streak, the losses will come. You will always have losing trades. But when the loss comes because they increase the risk to 10-20%, what happens? Again, the loss will wipe out all the win. Who's experienced that before? Marvin is asking, Adam, now you're a successful trader. Do you take higher risk? No, I don't. In fact, I tell you this, the older I get, the less risk I take. When you've been in the markets like me for 30 years and you've seen everything, I have seen the financial crisis. I saw the dot-com crash. I saw how many bear markets, how many crashes. I've learned my lesson. Right? Whether I'm investing or trading, to me, the most important thing is not how much money you make. It's not how much money you make. The most important thing is how much can you lose if it goes wrong. So you must always protect your downside. Always protect your downside. And the upside will take care of itself. The trouble with people is people always think how much they can make. They never think how much they can lose. Because they always think, I cannot lose. But in my mind, I know that this trade could be a losing trade. Then how? That's why I always keep my risk very small. So does Bang Fan Fan, so does Aosen Chu. You ask two of them, Aosen Chu and Bang Fan Fan are also very conservative. So we know that if the worst happens tomorrow, the market crash, we don't care. Because in trading, we got our stop loss. We risk very little. And for investing, we got very good companies. Drop temporarily, never mind, it'll come back later because they're good companies. Okay? So let me introduce to you what is the stock trading course. The stock trading course has got level 1 and level 2. Level 1 is known as the profit snapper course, and it's over 15 hours, 10 lessons. It's to take you from beginner to confident swing trader. Okay. Then level 2 would be the market snapper course, which is also 10 lessons and is 16 hours. So whether you're a beginner or you have a lot of trading experience, yep, it will give you a lot more strategies, a lot more tools, a lot more insights on how to up your trading game, right? So for the level 1 profit snapper, 10 lessons, you will learn what makes a successful trader, okay, the secrets of consistent trading profits, where we go into statistics, we go into probability to understand the probability behind trading. Trading is basically a probability game. It's a probability game, okay? Then lesson 3, you will learn about technical analysis, because trading is all about using technical analysis to find patterns, right? You learn things like Dow theory, identifying trends, support and resistance, supply and demand zones, and understanding how to use moving averages. Lesson 4, technical analysis part 2, right? And then lesson 5 will go into much greater detail into position sizing and how to place trade orders. So today I gave you a bit of an overview, but we'll go more into detail in the course on sizing positions and how to place trade orders. Like, when do you use a buy limit order? When do you use a buy stop limit order? And how do you enter the bracket order with the take profit and stop loss together? When do you use a day order? When do you use a good to cancel order? Yeah. Then you learn the different strategies. Some are trend following strategy, where you follow the trend, stage 2 uptrend. Some is stage 1, stage 3 reversal strategy. So lesson 6, you will learn trend retracement. And then lesson 7 is on psychology of trading, which I told you is very, very important. Lesson 8, how to develop a trading plan. Lesson 9, all about how to use the charting software and the brokerage platform, how to place trades, how to screen for trade setups. And lesson 10, trading the range strategy. So there are 2 strategies in level 1. What platform am I using? I'm using Interactive Brokers and Thinkorswim. Level 2, Market Snapper. You will learn the breakout within base strategy, which is one of my favorites. The breakout from base strategy, which I explained earlier on. The explosive flag breakout. Another approach called the momentum value rotation swing system. The slingshot mean reversion, which I taught you today, as well as how to anticipate trend reversals using divergence patterns. So to make it even more powerful, with the slingshot, you can actually use what we call divergence patterns, right? Another approach called Bollinger mean reversion, capitulation. These are older strategies that I still include in the course, but the slingshot is the latest iteration of this reversal system, right? The power of confluence. And lesson 10 is on intraday trading, day trading, which I can tell you upfront, I don't do anymore. I used to do day trading, so it was in the course, but personally, I do not day trade anymore. But the strategies and the lessons are still there if you want to do day trading. Yeah. So again, you can read my testimonials from my students, right? How much they make, right? All this, I think I've gone through so much of this in the last 3 days already, right? I showed you my track record, my accounts. This guy, YY, by the way, is one of my top students. He came for the class, I think about 7 years ago. And today he's one of our top traders. In fact, I would say he's on par with even myself and Bang and Alson, right? and he's actually our resident trading coach. Yep. So when you take the course, the stock trading course, and in fact the investing course, he will be conducting additional live sessions with you, right? His name is YY. And he was someone who's got a very interesting history, because before he learned to trade with us, he lost 80% of his money when he first started last time. He used to trade penny stocks in Singapore with no strategy. He would just try his luck. He lost 80% of his money. And then when he started to learn from myself and from Bang and even Alson, he got 195% return in his first 2 years of trading, right? And then from there, he built up his account. Every year, he does double digits. This year, year to date, his trading account is up 92%. And his investment account is up 50% year to date. And all these results, all these track record are shared with all the students. Through our Interactive Brokers account, we can print out all these statements, right? So you'll be definitely meeting him. He'll be conducting the Jumpstart workshop with you guys, right? Okay. So when you enroll for the stock trading course, we are giving out 2 bonuses. Number 1 would be the trademark trading tools, which I showed you earlier, the position sizing calculator, the trade stimulator, and also a trading journal to help you to record your trades. Okay. Bonus number 2, you will get a lifetime access to our traders community, our chat group, right? Where you can share your trades, you can ask questions and stuff like that. So for the stock trading package, you'll get level 1 Profit Snapper, 10 lessons, 15 hours. Level 2, 10 lessons, 16 hours, plus the 2 bonuses I mentioned. So the total value of the entire package is $7,376 US. And the usual course fee retail that people buy throughout the year is $5,676. For this black market crazy sale, guess, yeah, 75% off. Okay, so scan the QR code in front of you, and you can get this entire package for just $1,419 US dollars to get this entire course. All right. So go ahead, do a screenshot or click on the link, and you can purchase this course. Yeah. I'll give you a minute to do scan the QR code for this. Okay. So fast action bonus, yeah. The first 15 minutes, for those of you who enroll, you will get an additional stock trading live jumpstart workshop that's going to be conducted by YY, the guy I just mentioned to you. 92% return this year on his trading account and 50% return on his investment account. He is one of our top trading coaches. So 3 hours, he'll be doing a live jumpstart workshop to help you to get started with the trading course, right? For the first 15 minutes, you will get this additional jumpstart workshop. So again, you can scan the QR code over here, click on the link, and grab this package. I'll do a Q&A in a short while. Yeah. By the way, go on to piranhaprofits.com. You can see all our different courses are on sale. And again, this is a once in a year sale where you get really the best discount throughout the entire year. There are people who wait 11 months just for this sale. So we have got our stock investing cost, the value momentum investing cost. We've got the price action manipulation cost by Alson. We've got the options cost by Bang and myself. We've got a REITs investing cost. We also got a cryptocurrency cost by Alson. And we have got this stock trading cost, right? So do check out all the deals that are going during this sale, right? Let me share with you a bit more on trading. And like I said, if you want to succeed in trading, treat it as a business. To me, trading is like any other business. If you think about it, in any business, you are buying something and selling it for a higher price. Whether you're selling clothes, you're selling food, right? In trading, it's the same thing, except you're not buying and selling clothes. You're not buying and selling food. You're buying and selling financial assets, right? And in any business, you always have what? Sales. But you always have what as well? You tell me. In any business, you've got sales revenue, but you also have what? You have got costs of sales, right? Or cost of goods sold. So what's sales revenue minus cost? Is your gross profit. Is your gross profit. And then you have to deduct your overheads, your operating expenses, like your rental, your staff salary, then you get a profit. In any business. Trading is the same thing. Now, a lot of people, when they trade and they get a winning trade, they feel very happy. When they get a losing trade, they feel upset. Like, oh, why did I lose? And they don't feel good, right? Now, the most important thing is when you trade, you have to understand that as a business, when you have a winning trade, it's like the sales revenue, 2R. When you have a losing trade, it's like the cost of the business, right? So even if you have a 50% win rate, where every win, you have a loss. Every sale, you have a cost. Do you still make a gross profit of 50%? Yes. So you cannot say, in my business, I want revenue. I don't want cost. That's unrealistic. There's no such thing. So same thing in trading. You cannot say, I only want wins. I don't want losses, right? So when you think of losing trades as the cost of the business, as a part of the game, you no longer feel bad when you have a losing trade. And you no longer get your psychology affected. You follow? And the great thing about a business is that you don't have operating expenses. You don't have to pay staff salary. You don't have to pay rental. You don't have to keep inventory. That's why, to me, it's a great business. Yeah. And it's a business where you can work from anywhere in the world. It is so flexible. You don't need an office. And you just need 1 to 2 hours a day. You tell me, in what kind of business can you just work 1 to 2 hours a day? No. If you start a business today, you have to work like 15 hours a day. But in trading, 1 to 2 hours a day is good enough. Just find the trade setup, enter the trades, that's it. No employees, no rentals, no competitors, recession-proof. I don't care if there's a recession next year. I don't really care, right? Because wherever the price goes, we can take a long trade, we can take a short trade, yeah? And relatively low startup capital. Any business you start, you want to start a restaurant, you want to start a boutique, it costs a few $100,000. In Singapore, at least $1 million. But in trading, you can start with as little as $1,000 or $3,000 or $10,000 with as much as you're comfortable with, right? And trading, to me, is relatively low risk. Because if you start a business and it fails, and you guys know 95% of businesses fail, right? You lose everything. But in trading, every time you risk only 1%, right? Now, you tell me, even if you have 100 losing trades in a row, which is impossible, but let's say you're the most unlucky guy in the world, okay? And you have 100 losing trades in a row, and each time you risk 1%, will you lose all your money? Will you lose all your money? Yes or no? You tell me. Yes or no, guys? If you risk 1% and you have 100 losing trades in a row, will you lose all your money? No. Why not? Why not? Because remember that every time you risk 1%, you're risking 1% of the balance capital. You follow what I'm saying? So it's always 1% of the balance. So each time you risk 1%, you're risking less and less and less and less. So your losses actually decelerate. So you can never lose everything. But when you have a winning streak and your capital grows, you're risking 1% of a bigger amount. So the great thing about this technique is that when you win more and more. But when you lose less and less. That's why this system works. Okay? And the great thing about trading is that, and I tell my students this, please, when you start trading, do not trade with real money. Always paper trade with a demo account, with demo money. Only when you can make consistent profits with the demo account, then you use real money. It's like a pilot. You don't start flying a plane with real passengers. You have to go into the flying simulator, take off and land many times confidently, then you fly real passengers, right? Same thing with trading. You can't do that in a business. If you want to start a restaurant, you can't say, I'm going to open a demo restaurant with demo food and demo customers. If I can make money for 3 months, then I start the real restaurant. You can't do that. But you can do that in trading. In trading, you can start with a virtual account, and only when you've got the skills, then you use real money. So don't be in a hurry to make money straight away first. Focus on learning the skill. Then the money will come. Right? Okay. So I hope that gives you a good idea. All right. So once again, guys, you'll be getting the level 1 course, level 2 course, 2 bonuses, and the fast action bonus for the first 50 minutes when you enroll, the additional 3-hour live workshop by YY. So that's $1419 US for a limited time offer. Yeah. All right, so let me answer some questions, guys, as you guys are enrolling in this class. Give me a second. Okay, when to use MA and EMA? Asked by To Ing Tan. For me, I use EMA for short-term moving averages. So for the 20 and 40, I use EMA. For the 50, 150, 200, I use SMA. Okay. Alex is asking, how do I know there's a false breakout? Okay. So it's very common that you have got this thing called false breakout, right? When you trade breakout patterns. So let me give you an idea what's going on here, right? So this is a resistance, let's say, and the price goes up, comes down, goes up, comes down, goes up, comes down, and then it breaks out. All right. And then you buy here, and what happens? Goes back down. We call this a false breakout. Okay. Now, the question is, how do you minimize the false breakouts? We can't 100% get rid of it. As in, sometimes you can enter and it could still be a false breakout. We can't avoid 100%, but we can mitigate false breakout. So how do you mitigate it? So let me give you a few tips. Let me give you a few tips, right? So the first tip is this. See, the price goes up, hit down, right? So test 1, test 2, test 3. Now you have to make sure that before the price breaks out, the price must, how do I use this word? Okay, if the price goes up like that straight and then breaks out here, you don't buy it. Because it's like, think of it as this person running. They run. By the time he gets out of the gate, he's tired. He loses energy and he'll come back. So this is what causes false breakouts. After a strong run, the momentum is weakened and it comes back. Okay. So what you want to see instead is this pattern. Price goes up, price goes down, price goes up, price goes down, price goes up. Now, before the breakout, the price needs to consolidate first. You need to see very tight consolidation here before the breakout. Think of it as this guy, before he runs out of the gate, he's resting. He must be resting here first. Then when he runs out of the gate, he has the energy to keep running. So you must always wait for a tight consolidation here. And during this tight consolidation, if you look at the average true range ATR, the ATR must be falling here. That means we call this volatility contraction. Before the price moves, the volatility must contract. We need to see very small price movements, and then the price breaks out. So that's one tip. Second tip, during the breakout, you need to see volume. The volume needs to pick up here. You need to see a surge in volume. All right, so that's the second tip. Yeah, so these two would mitigate a lot of false breakouts. Now, the third thing you can do if you are more conservative is don't buy on the first breakout. Okay, don't buy on the first breakout. So what you do is there's one, there's two, there's three, consolidate, breakout, right? Don't buy here if you're conservative. Wait for the price to move up first and then come back and retest the resistance support. Retest, then you buy on the retest. We call it a breakout retest pattern. You can do that if you're more conservative. But the problem with doing this is that there'll be times when the price breaks out, it doesn't retest. It just flies up. And then you may miss certain trades, right? If you want to wait for retest, you'll miss certain trades, but then it would minimize the false breakout pattern. Okay, so that's to answer Alex. Do I recommend buying gold? Well, to me personally, not as an investment, but as a short-term trade. If there's a trade setup, sure. But I won't buy it as an investment because long-term is a non-productive asset. And non-productive assets always underperform productive assets over the long run. So I like to buy productive assets that generate cash flow, right? Like rental income, like rental property or companies that generate cash. Gold doesn't produce anything. You just buy the gold, you look at it, fondle it. What can you do? Cannot do anything. Can just stare back at you, right? Susan is asking, how about weekly chart? Yes, you can trade on weekly charts as well, right? The only thing is weekly charts will take a bit longer to hit the profit target, of course. Yeah. Let's see. What is the win rate? What is the win rate of most of the strategies is, like I said, 50 to 60%. That's the win rate, 50 to 60% of any reasonably good strategy. Okay. Adams, Jacks do not follow the news. Yes. So in fact, if you listen to what Elson teaches, Elson who teaches price action manipulation, same thing. Elson, Bang Fan Van, myself, we never trade based on the news because the news is all manipulated. We trade based on the price action, based on the price action. In fact, there are many times I can tell you that when I or Elson or Bang, we bought a stock, it had the worst news. It had the worst news. Whether is it terrible news about the stock or terrible news about the economy, it was the worst news when we bought because we saw the reversal pattern. It's all about the price action. Okay. Is Palantir in a breakout of base pattern or double top pattern? Palantir, let's look at Palantir. By the way, I'm invested in Palantir, right? I'm not trading it, I'm investing in it, all right? So Palantir, interesting. It actually, if you look at Palantir, right, this was actually a base, right? And then this was actually a breakout, right? Breakout and then retest. Can you see? Breakout, retest, and now it's here. Now it's on the way up. Probably next target, $25, right? Yeah. Is there a double top? No, there's no double top. At least for now, no double top. No double top. Okay. What does double bottom within 3 bars mean? Okay, what does that mean? What is double bottom within 3 bars? Give me a second. Okay, so what that means is basically when the price comes down and it makes a low here, and let's say this price comes down here like that, 1 bar, 2 bar, 3 bar, and let's say this is the bar that went below that low, right? So this is bar 1. This is called bar 1 or candle 1. Okay, so let's say candle 2 is here. This is candle 2. Okay, by the 3rd candle, it must close back above this line. That's what it means. By the 3rd candle, it must close back above this line. Okay. What's my definition for small company? The definition is small cap company. Small cap company, typically their market cap is typically below $1 billion. Typically below $1 billion market cap. What's the difference between beta and relative strength? Okay, so James is asking, okay, beta is a measure of volatility, right? Beta is a measure of volatility. So if a stock has a beta of 1.5, that means the stock is 50% more volatile than the S&P. That means if the S&P goes up 1%, the stock may go up 1.5%. If the index goes up 1%, the stock will go up 1.5%. If the index drops 1%, the stock will drop 1.5%. So it's a measure of volatility. It doesn't tell you how good the company is, how good the stock is. Okay, it just says very volatile, right? But relative strength tells you that the stock, the price momentum is stronger than the market. So that's the difference. Okay. Is Disney considered a valid short trade? No, it's not a valid short trade because it is not, there's no double top, there's no resistance or anything like that. Okay. How do you determine the entry price and stop loss on the Lulu example? Okay, so like I said, for the slingshot, the buy entry is just above the high of the candle. Right? So this bullish candle here, the buy is just above the high of the candle. It could be like 10 cents above the high. Given that it's a $300 stock, you can put a buy order about 10 cents above the high of the candle, and the stop loss like 10 cents below the low of the candle, right? Do I buy Singapore savings bonds? No, I don't. Trade idea for bond rebound. Yeah, in fact, I have started to enter bonds using the TLT, right? So in fact, I think I showed you guys that, right? If you look at my account, yeah, up about 18 grand today. So yeah, I actually use options a lot, right? So many times I look for the trade setup, like the breakout within base and the slingshot, and oftentimes I use options to enter, because with options, it becomes more powerful, right? But you can use stocks as well. So like for the TLT, you can see I entered my TLT using the synthetic options, right? Which is the same as buying the shares. But the reason I use options is because options uses less capital. It uses less capital, right? So you can see I'm up about almost 4 grand on this one. And then this other account here, up about 4 grand on the DLT here, right? So by the way, these are all my swing trades. These are all my trades, right? But I tend to use options to enter, right? So when people say, Adam, which is the better cost, options or stock trading? To me, you got to take both. That give you the optimal, right? Because the stock trading course teaches you how to find the setup. It's like a military example, right? The stock trading course is I teach you how to find the enemy, where the enemy is located, and how to aim at the enemy. But the options gives you all the different weapons, where if you just buy the stock, it's like you're using an M16. But with options, you can use a sniper rifle. You can use a GPMG, general purpose machine gun. You can use a shotgun. You can use an Uzi. You can use a rocket launcher. So options are the different weapons. But the stock trading course teach you how to aim the weapon, how to find the enemy. You see? So to me, the best is you combine both the stock trading or the price action manipulation to find the setup, and then the options to execute. That gives you the most powerful combination, right? Understand? Okay, so I've got just a couple of minutes left. Let me just answer last few questions. And remember, the QR code is over here. Those of you who are enrolling right now, do take advantage of it. It's over here. Yeah. Considering the current market, I'm thinking of allocating all my capital to T-bills. Really? We can sell puts on solid companies. We've done value investing on them. If assigned, we sell T-bills to buy the stock. No, I wouldn't touch. No, the trouble is, if you buy T-bills, yes, you get a good interest rate in the short term. But once they start cutting rates next year, then your T-bills will have very low return and you're stuck with all the cash. And by the time the stock market will have already gone up so much, and you may be too late to buy stocks already because they'll really be overpriced by the time that happens, okay? Because now the stock market is just at the early stage of the bull market. And now that rates are beginning to come down, in my opinion, the market will have a lot more upside. And by the time you wait for that, it's too late. Things will be too expensive to buy. Now things are not too expensive yet. Okay. What's my outlook for the S&P for 2023 and 2024? Well, if you watch my 6-wave event webinar in July, I'm very bullish on the market for at least the next 10 years, right? Because we're in a secular bull market. Secular bull market lasts 20 years. And we are right now halfway through the secular bull market. And in every secular bull market, there are 2 bear markets, which we just went through. We went through a bear market in 2020, another one in 2022. We've already finished the 2 bear markets. So in my opinion, I think the next 10 years will be very, very strong. I could be wrong. I can't see the future. That's just my opinion. Okay? All right, guys. So thank you for listening. Really appreciate you being here. And I hope you learn a lot today. Yeah. By the way, tomorrow, remember that there will be another webinar by Bang Pham Van, where he'll do a live trade hunt using his latest strategy. So do tune in for the webinar tomorrow as well. And for this webinar, thank you for listening and take care. And I look forward to seeing you in the community. Yeah. Good night.